Mr. Mani tries to put us on the chat mode, let's go back to our presentation.
I'll take a second more just to double check. Anybody can unmute and tell me whether you see the chat box, because the chat box is open now.
Yes, sir, we can see the chat box.
We can see the chat box. Yeah.
Okay, so just put in a dummy question so that Murthy can have a look at it for comfort.
But we are allowed to answer to only you and Mr. Murthy.
Professor Murthy,
Not
yes.
for everyone. Yeah.
So I've sent a hello to Professor Murthy.
Yeah, so you send it to Professor Murthy, no? That's the whole idea. Don't send it to me. I don't have the answers. He's the finance expert. So just send it to Professor Murthy.
Professor Murthy, I've sent you a hello. Maybe now you'll be able to see.
I have also sent him a message. Yeah.
I'm not able to see the chat on my computer.
1 minute. You are the co-host, so this problem should not happen at all.
Professor, input me beside chat and share screen. I mean participants and share screen. Between participants and share screen.
Okay, now just check.
1 minute. Yes, I'm able to see the chat now. Thank you very much for that, Professor.
All right, go ahead.
I'll just go back to the share screen. Okay, sorry for the interruption. So we were discussing about why it's important for every manager to understand finance. And one of the very important reasons is we cannot manage what we don't measure. Whether it is marketing or purchase or any other discipline, whatever we are responsible for managing, we cannot manage what we don't measure. So I have had this experience over 36 years as a finance manager and CFO, that month after month, after the MIS is generated and shared with the business managers and of course the executive director, there was always this question that, Murthy, you are showing 1 crore of rupees of profit for this month, but my calculations say that I should have earned at least 2 crores, and so your numbers are wrong. This is a typical conversation month after month in many organizations that I experienced. So friends, after a thorough review, item by item, we invariably came to the conclusion that the numbers which the finance department has given most of the time are perfectly right, and there's nothing wrong with those numbers. So this only demonstrates the fact that, you know, finance department, which is day in and day out engaged in measuring financial numbers or outcomes, has a better understanding of the outcomes. Now, the argument which my business managers used to give is that we have done our back of the envelope calculation, and it's very obvious that we shouldn't have earned less than 2 crores. So after proving that, you know, the detailed measurement that the finance department is engaged in, I had to tell them that unfortunately you cannot manage an organization with back of the envelope calculations. It is okay maybe for an elevator pitch or for a quick conversation with a customer or some other context. But if you are talking about managing the organization, you need to understand that you can't manage what you don't measure. Friends, I have had this experience even in my consulting experience in recent years, that a few of my clients, they had a view that, look, Mr. Murthy, this year we are going to double our business and we will do, as an example, 100 crores. So I used to say that's very fine, but let's check the numbers. When we sit for checking the numbers, it probably ended at 50 crores or 60 crores or 70 crores. And I used to make my point that you cannot manage what you don't measure. And that's where, of course, the finance function comes into play. That's, of course, one important reason why we should understand a little bit of finance so that we understand how to go about the measurement process. The second important reason I think why some understanding of finance is important for a manager is to understand the data or the reports or the financial processes in the context in which they are generated. So without that context, I'm afraid the significance of the financial data or the reports will be lost. And of course, the last is the third important reason is finance is all about scorekeeping. It gives the score, and the business is like a game, and you cannot play a game without knowing the score. So friends, these are three important significant reasons why we should have some understanding of finance. And yes, this is a bird's eye view of what your finance department does day in and day out. I will not go into details. Some of these aspects we will be covering in the course of this session. But suffice it to say that there are a lot of things covered in the finance function in a corporate context, much beyond, of course, what normally is imagined. So if somebody wonders why are these finance guys burning so much midnight oil, that's the reason. There are a variety of things they do, and each of them is a very important aspect of the organization of finance. So we see here that the finance function is changing in terms of its increased partnership within the organization, as well as, of course, the increased corporate responsibility. We all know of the accounting scandals or financial scandals that happen in organizations, stories such as the Enron, stories such as the WorldCom, or the Barclays Bank, the 300-year-old bank which collapsed. Some of it, of course, is because of the insufficient or inadequate financial controls, or maybe the management controls to some extent. But the point that I would like to say is that the role of the finance department is something which is changing. These trends are visible in the last 30, 40 years. So traditionally, finance is viewed as a scorekeeping function, what we call the financial accounting and reporting. But by virtue of the fact that the finance department gets an overview of what is happening in the organization, or total organization, next only to the CEO, in terms of a detailed knowledge of where the numbers are headed, first-hand information about the numbers, the finance function is equipped to be a commentator. That was the next role which has emerged in the finance role. And the third, of course, is the finance is a trusted advisor, the diligent caretaker. And finally, over the last 30 years, what we are seeing is that finance emerging as a business partner. So this is very important, not only for the CEO, but also for the business manager, who could probably sort of partner with the finance department to understand. You know, there are so many dilemmas. For example, a marketing manager, shall I take this order or not? So on and so forth. So the finance is expected to be a business partner, and that is the changing role of the finance function. So friends, this is what actually happens in the accounting context in an organization. There are transactions, vouchers, accounting entries, ledgers, and what we call a trial balance in an accountant's terminology. I think that's not important for the non-finance managers in this session. What is important for them is the understanding of the profit and loss account and the balance sheet. So we will leave the first few boxes up to the trial balance to the accounting department, and we'll spend some time understanding this profit and loss and balance sheet. So accounting is a very specific science, and there are a lot of principles on which the accounting or financial statements are generated. I just enlisted them here. They are not important for a non-finance manager. They are the important guideposts or the guidelines for the accountant. And I will come back to this when there is a curiosity in terms of why certain the financial statements portray numbers in the way they do. So in terms of the financial statements, we have the profit and loss account, which is the primary statement, which deals with the incomes and the expenses in a given period of time. And we have the balance sheet, which is a statement of assets and liabilities as on a particular date. What is important here is to note that the profit and loss account is for a period of time, be it a month, a quarter, 6 months, or 1 year. A balance sheet is as on a date. Most of us have heard this term profit and loss account and balance sheet. So we will be looking at some practical examples of these two important statements in an organization. But what probably is the importance of which is less known is the cash flow statement. So in addition to the profit and loss account and the balance sheet, one more very important financial statement is the cash flow statement. The cash flow statement is significant because profit is not necessarily cash. So your profit and loss account could show a profit, but then you are short of cash. Look at all those organizations which have gone for insolvency, the IBC court, or even in yesteryears, we used to have companies which had wonderful profits, but they could not pay the wages or the salaries. Even in my own experience, the conversations I have with startup entrepreneurs who ask me this question, we are doing quite well, but why is it that when the time for payment of the salaries comes, the heart beats a bit? So the question is, we are profitable, but where have all the profits gone? Why are we tensed up before any major commitment like payment of salaries? So the answer lies in the cash flow statement. And there's a lot of significance for managers of this cash flow statement because that is where certain managerial processes coming under the broad category of financial processes becomes very important. So let's just go back to understand the significance of the cash flow statement to these accounting concepts and principles. So accounting per se is based on what is known as the accrual concept. So what it means is that whether paid or not, if an expenditure has been incurred in a given period, we have to recognize that expenditure in the profit and loss account. We're not paid it, but we have to recognize it. An example I can give is salaries for the month of March or any other month, say for the month of March, which get paid in the first week of April. And if we are making the profit and loss account as on 31st March, we recognize the cost of salaries in the month of March. We say that we will provide for that salaries. Why do we do that? Because of the accrual concept. And number two, also because of the matching concept. If I want to recognize the income of March, realized or not, because of the accrual concept, I should also correspondingly consider the cost side of the equation. And therefore, items in the P&L account may or may not have happened in terms of cash inflows or outflows. So let's take the other example of sales. Say we have sold X amount of quantity for Y amount of value in the month of March. So we attribute it as an income related to the month of March, and we recognize that income. But we might have given a credit. We might have given a credit of, let's say, 60 days or 30 days. That means we will realize that sale only in April or May. But we have recognized the income in the month of March. So the point is, when we make this profit and loss account, we are actually recognizing expenses and incomes which are not necessarily incurred in cash terms. Because of this variation of what we recognize in P&L or profit and loss account vis-a-vis the actual cash inflows and outflows, we have to make a separate statement based on the cash inflows and outflows. That's called a cash flow statement. And of course, the balance sheet is a statement of assets and liabilities. What I'll do is I will here go for certain examples. I'll show you on this Excel sheet. Are you able to see an Excel sheet?
No.
Okay, I will share it now.
Not yet. Yeah, now
Yes.
it's yes.
Yeah. Okay. So I'll not spend too much time in explaining the numbers here, but you can see the profit and loss account. This is the profit and loss account of company A. This is the profit and loss account of company B. I'm using a vertical format of the profit and loss account. There is also an alternative format, which is a horizontal format or a T format. This is more convenient for analysis, and of course, most companies use this vertical format. Let's just get familiar with this format. And what we see here is that in the case of these two companies, the data shown here is say for the current year ending 31st March 2020 and the previous year. It is a convention and also mandated by law to show the information for the current year, which in this case is the year ending 31st March 2020 and the previous year. So in the case of both the companies, we see that 2 years data is available to us. So we start with the income. As we know, the income could be revenue from operations, the actual business that we are in, as well as income which is what we call other income, which is non-operational. Maybe a surplus money put in a fixed deposit, we earn an interest, or we invest in some mutual funds and we get a dividend, so on and so forth. So we have the income, we have the expenses, and of course, we have the direct expenses as well as the indirect expenses. I'll explain the significance of this classification. We have the interest cost. So what is very important is profit is the surplus of income over the expenses. In the normal course, we would understand profit as being one number or one figure. But when it comes to the financial statements or the subsequent analysis which we will be discussing, the profit is looked at different levels. So we have the gross profit, and here we have the gross profit. We have the operating profit. We have the profit before tax and the profit after tax. We're looking at profit at 4 levels. Why? When we are talking about the gross profit, we are looking at the revenue from operations and of course the other income, and deducting from it the direct expenses. What are direct expenses? Direct expenses are those which are directly related to the business operations. For example, the purchase cost, or if it is a manufacturing company, the labor which works on the machine. We call it a direct labor. So when we only consider the expenses which are direct in nature and deduct it from the income, we get the gross profit. There is a significance for this word gross profit, or this level of profit. This is the profit which is actually the result of our business model, or how efficiently are we actually managing the business operations. Say if we are a trading organization, we purchase things and we sell things. How good are we in these two essential activities, essential operations of buying and selling, is reflected in the gross profit. On the other hand, to do this business of buying and selling, we also need to incur a lot of other common costs or indirect costs, those which are not directly related to sale or purchase. So what are those? We have indirect employees, for example, the accounts department, the HR department. We have the administration expenses, the rent we pay for the office, the rent we pay probably for the godown goes into the direct expenses, or other kinds of rents. Maybe we incur expenditure to advertise. One might say advertising is essential for sales, but from a financial point of view, you can sell whether you advertise or you don't advertise. So what is a fundamental analysis? Directly on purchase and sale, and the other is that which enables sales and purchase. That's what we call the sales or general administration overheads. So when we remove this, broadly referred to as indirect expenses, we get the operating profit. So at the level of the operating profit, we are getting to know, after the direct and indirect expenses, where do we stand in terms of our profitability? Now, there is one more item which we have not accounted for in the statement yet. That is the interest cost or the finance cost. We are not considering it as even the indirect expense. Of course, it's not the direct expense. For the reason that interest cost is a function of the management policy. In a particular organization, the management may decide that I will not borrow. In yet another organization, the management may decide that I will borrow 50% of my needs, financial needs. So it is a policy decision, which is not directly related to business. So business A may borrow, business B may not borrow. So to understand, excluding that policy cost of interest, financial policy cost, we look at the operating profit separately. Then of course, if we also take out the interest cost, we get the profit before tax. Of course, in this particular case, it's a loss. and so there's no tax expense. But if there were a tax expense, as in this particular case, they had a profit of 350, 1/3 I'm taking as the tax. The profit after tax is 245. What is the significance of profit after tax? The significance of profit after tax is this is what is left for the owners. That is what they carry home. That is what is left for the shareholders. So this is a P&L account. Similarly of B, without much ado, I will move on to the balance sheet. Of course, what we see in the P&L here is the company A is a loss-making company, company B is a profit-making company, company B is doing exceedingly well. It is giving a return of 12.56% to the shareholders, whereas company A is giving a negative return of 3.7%. And we can also see why is company B doing well. Company B is selling more than company A. Company B is more efficient in terms of its purchase function and its cost structures, which I will be explaining in a separate part of the analysis, in the financial statement analysis.
Murthy sir, Sanjeeva
Yeah.
Reddy,
Yeah.
can you explain this EBITDA? Because is it the gross profit, EBITDA?
No, Mr. Reddy. I'll be coming to that. We are actually, after we get a broad view of the P&L and balance sheet and what it contains and the cash flow,
Fine.
we will go into what is known as financial statement analysis. At that stage, you will understand EBITDA and many other measures actually.
Fine. Thank you, sir.
Okay. I would just like to tell the participants that I'm still not able to see the chat, maybe because of the screen share. So if anybody has a question, please interrupt me, and that will be interactive also. Otherwise, it will be a monologue. Just as Mr. Reddy did, please do interrupt me. Okay, so we have come to the balance sheet. So it's quite clear that the P&L account is just dealing with the incomes and expenses, and the balance sheet is dealing with assets and liabilities. We have company A here, we have company B here. Again, in a vertical format, I'm starting with the liabilities. Both companies have started in the year 2019 with a share capital of 1,000 and 1,000. So there is an opening share capital of 1,000. They have not increased it, and therefore it remains 1,000 at the end of year 2. It remains 1,000 at the end of year 2. Company B, of course, had profits, as we have seen earlier. Net profit of 245. That led to increase in the reserves. Reserves are nothing but what belongs to the shareholders, and they get it when it is declared as a dividend. Whereas in the case of company A, because of a loss, the reserves have actually come down, 221 to 170. The important point is, in this balance sheet, we see all the liabilities listed first, and the first item is the shareholders' funds. Why is it that a capital contributed by the owner, why is it a liability? If anybody would like to give an answer to this question. Why are we showing our own contribution, which is our own capital in the business, as a liability in the balance sheet? Okay.
Is it because when the company,
Please carry on.
Is it because when the company gets liquidated, they can claim this share value or something like that?
That's partly right. But if you could be a little more specific, yes, you are right. In fact, the shareholders will get whatever is left in the company when it is liquidated. But having said that, Okay. Anybody else would like to?
Because maybe a company is the individual entity, so any money that it borrows, even from the owners, has to be paid back after some time.
Yeah, absolutely. That's right. So let me just put it in the perspective. I have shown you certain set of accounting concepts or accounting principles as the foundation of the science of accounting, right? I've shown you accrual concept, the matching concept. We discussed one or two of those. I mean, the idea of putting that slide was only to say that accounting is a very definitive science. And one of the concepts which I enumerated there is known as separate entity concept, which means the business is distinct or separate from the owners. When the owners are putting their own money in the business owes it back. That's, I think, what has been said by one or two of you. But we call it a separate entity concept. The business is different, the owner is different. Yes, for the owner, it is an asset. If you're drawing the balance sheet of the owner, you will show this investment in the business as an asset. But right now, we are talking about the balance sheet of the business, and it owes back to the owner because the business is separate, it's distinct from the owners. So that's the reason why it is a liability. Anyway, whatever belongs to the shareholders, the original amount they put plus the surpluses which remained in the company which they are not taken out as dividends, the sum of it is known as net worth. The net worth is completely the shareholders' money. Now, businesses need to raise funds to operate, sometimes over and above the share capital. In fact, it's a good policy to have some amount of debt. So when we raise this finance or funds, we could be raising it as loans which are repayable maybe after a few years, or we may issue debentures. The lenders and the debenture holders are not shareholders. They're simply lenders. So under the liabilities, we have a category of items known as long-term or non-current. There is a significance for all this terminology which I'm using. I request your patience because ultimately when we go to understanding the financial health of the organization, all these terms which I'm explaining will become very, very important. So we have liabilities which are long-term in nature, which are non-current, and we call anything which is more than 1 year as non-current or less than 1 year as current. So under the current liabilities, we have the trade payables. That is the credit we get from the suppliers in the normal course. We have other current liabilities, which could be, for example, taxes paid to the government, which are refundable back, like the GST credits. Or it could be the salary in the case of short-term provision. As in my earlier example, the salary for the month of March on 31st March, if it is not yet paid, I make a provision. So I have to pay it as on 31st March, right? These are all current because they're all payable within 1 year. The sum of all this is the current liabilities. So the liabilities from the business point of view are what it owes to the shareholders back, the long-term loans that it has taken, and the current liabilities, totaling to total liabilities of 3,466 in this example. What did the company do with all this money? It has invested in property, plant, and equipment, fixed assets, furniture, computers, right? And It is not enough to have machinery and buildings and computers to run the business. We also need to invest in our clients by giving credit, what we call trade receivables or debtors. We need to maintain enough cash balance. So there's cash and cash equivalents, short-term loans, inventory, etc. So we have current assets, we have fixed assets, both of which total to the same 3,466, equivalent of the liabilities. The balance sheet always tallies. If it doesn't tally, you must change your accountant. Because these days computers help us to tally it much better. Otherwise, in the olden days, a lot of midnight oil was being burnt to tally the balance sheet. So same in the case of this company. So we are now seeing the balance sheet. And we have seen the P&L account. But as I said, while these two are very important financial statements, it doesn't tell us whether the company is having enough cash flows to meet its liabilities. Is it cash rich or cash poor? I mean, in the olden days, business people used to fabricate their accounts to show huge profits. But the fact is that they had no money to repay the loans. Some of which is now, you see it in the IBC proceedings, that large respectable groups like Ruchi Soya, like for example, Alok Industries, or even the Anil Dhirubhai Ambani group. So many companies of the ADAC group are in trouble. So they're not able to repay the loans. Why? Because the cash flow is poor. So let's look at the cash flow. The cash flow is again summarized into three categories. Cash goes in or cash goes out. One, because of the operating activities. Cash flow from operating activities. Right? I hope everybody is agreeing with me on these concepts. Cash generated from operations. The other is, we also engage in investment activities. We buy machineries. We buy computers. And we repay loans that we take. Right? So there are investment activities. And so far as the repayment of loans or taking new loans is concerned, we engage in financing activities. The sum total of A, B, and C is, of course, the net change of either increasing the cash balances or decreasing the cash balances. I'll just briefly explain this quickly. It's a very significant statement. As I told you, if the bankers, if all the lenders have kept a close watch on the cash flow statements, we wouldn't have had so many non-performing assets and insolvencies. So when it comes to the operating activities, we have here the profit before tax. Depreciation is an operational activity. That's the charge for the assets, diminution in the value of the assets, use of the assets. But it's a non-cash cost. So I'm adding it back. Though it's an expense, it's a non-cash expense. Interest received. This is income from an investment activity. That is investment in fixed deposits or whatever other instruments. I'm just reclassifying it. I'm removing it from operations. I'll put it somewhere else. I'm just doing a simple activity here. I'm putting all the boys on one side, all the girls on the other side. So I'm just trying to group and regroup. I'll take back this 150 again under a different heading. But here I'm reducing it. Interest paid is a financing activity. So I'm adding it back to my profit. So finally, I have arrived at before working capital changes, 4 crores as my operating profit, which is different from the 350 which we saw in the P&L account. Now, what did I do with this 400? I increased my debtors. I'm not going back to the balance sheet, but trust my word. If you go back to the balance sheet, the debtors have actually increased. That is here by 100. Part of my operations of finance are funded by my creditors. So that's a source for me. Other current assets have consumed my cash. And after all these adjustments, I have generated 335. And after the tax, under the operating activities, I had a net surplus of 2 crore 30 lakhs or 230. So in a similar way, if I do all the adjustments for the investment activities, I spent 4 crores on getting new assets. That's an investment. I received 1 crore 50 lakhs or 150 from my fixed deposits as interest. That is also a result of investment. I'm just regrouping. I'm putting similar items at one place. And after all these adjustments I have here, I have used up 250 under the heading of investment. And financing, I borrowed 2 crores extra. I paid 1 crore of rupees interest, and net, I had a cash generation of 1 crore. When I combine these three operating activities, financing activities, investment activities, I have ended up with a cash surplus of 80. If you see the balance sheet, at the beginning of the year, I had 120 as my cash balance. It has become 200 because 80 is what I have generated. So what does this tell me? It tells me that I have generated 80 lakhs of surplus cash during this year. Whereas this other company, A, which had poor operations, has actually consumed its cash balance at the beginning of the year. 150, it's consumed 130, so it became 30. So I don't think I need to go back to the balance sheet to prove these numbers, but just if you are in agreement with me that this cash statement or cash flow statement is completely different from a P&L account. I think it suffices. So just to go back to this company B, which is more successful, it had a profit of 350 net. After all the working capital changes, it made a 2 crore 30 cash surplus out of operations. But then it also made investments, borrowed, earned some interest and all. It made a net investment, which is an outflow of 250. It did some financing activity, borrowed some money and paid some interest net from the financing activity. It has 100 surplus. The effect of those three items is 80 lakhs surplus cash generation, leading to increase in the cash balance from 120 to 182. So that is about P&L balance sheet and the cash flow statement. That's the importance of the cash flow statement. So let's get to the ratio analysis, which or the financial statement analysis. Before that, I will just go to the PowerPoint once more. Okay. The reason we make all this financial statement is to study the financial health of an organization. So I have a question here. What will we look for in knowing how healthy an organization is? Financially, of course, the conversation is all about financial health. Or if I may give you a context for my question, there's a very strange coincidence that Doctors' Day is July 1 and Chartered Accountants' Day is July 1. And around July 1, there is always this WhatsApp chatting goes, why is it so? So one of the answers that comes is that doctors as well as chartered accountants and of course other fellow finance professionals both deal with health. Doctors deal with health of the people, and the finance professionals deals with the health of the organization. So both deal with health. So the doctors, of course, as you know, when we go for our annual health checkup, they perform a battery of tests, and they are concerned with a variety of things: the cardiac health, the orthopedic health, ENT, so on and so forth. Similarly, the finance professional would assess the health of an organization, financial health, by with a lot of areas that he would like to consider. So my question is about how will you determine whether an organization is healthy or not financially? I'll be happy if some answers. Yeah. Sorry?
वो आ गया करके वो थोड़ा भिजवा दो मेरे पास
Sir, I think it's a little unclear. If you could kindly speak louder.
पिक्चर भेजा मैंने वो मेरा लड़के के हाथ में थोड़ा गर्म पानी गिर गया तो उसके लिए ऑइंटमेंट चाहिए वो जब मेडिकल में उधर मिला तो मेरे पास जरा लेके भेजो कुछ 100 रुपए का है दे दो मैं बाद में देता हूँ जरा वो कर दो जरा ये जल्दी दोनों भी इमीडिएटली भेज दो ना वो दवाई भी और ये जिप लॉक ठीक है और कल तुम फ्री रहोगे कभी हम लोग को हिसाब पूरा कर लेते हैं शायद तुमने कुछ 19-20 किया है मैं कल बात करता हूँ ठीक है ये जरा कर देना मेरे प्लीज अभी मैं निकल नहीं पाऊंगा मैं इधर बिहार में
Yes, sir. Any views on how we would measure the financial health of an organization?
I think you said that it's a balance, this profit and loss statement.
So are you saying profitability is one of the criteria? You would think you would say an organization is healthy if it is profitable?
Yes, profitability, debt.
Did you say debt, sir?
Yes, debt. Yes.
Okay.
How much debt is the debt to debt ratio?
Sure.
So
Debt.
conversion, inventory to sale.
Did you say inventory to sale?
Yeah, converting inventory to sale.
So you are saying turnover related.
Yes, sir.
How much liquidity a company has?
Oh,
The
that's
cash.
good. Liquidity. Okay, ma'am. Liquidity.
Is there an interest outgo?
How much is the company leveraged?
Yeah.
The loans. That
Can I put it interest outgo here? Because ultimately the interest impacts the profit, right?
The liabilities, current liabilities to current asset ratio.
Yeah. I will call it current
Working
assets
capital.
and current liabilities. You said working capital, right, madam?
Yes, sir.
Yeah. So I think we have touched the right chord. I'll just put this in a little more formal sense, and that's what we see here. So that's what we see in this slide. We determine the health of an organization through what is known as financial statement analysis. And the financial statement analysis deals with, of course, as you all said, the profitability ratios. We looked at gross profit, we looked at net profit, operating return on capital employed. I briefly mentioned those when we were reviewing the P&L account. And somebody said debt. Yes, that is the solvency ratios, we call it. Solvency refers to the long-term debt position of the organization. And we also came out with this liquidity, current ratio, etc. That's what, and of course the word working capital has come out. That's all coming under the liquidity part of it. The difference between solvency and liquidity being solvency reflects the long-term financial health, Liquidity will tell us the short-term financial health. And we talked about turnover. We also say these are efficiency ratios. These are efficiency ratios. Yes, one of the critical components in this ratio is the turnover and earnings ratio, which we can actually merge with this profitability ratios. So these are all the ratios that we work with to understand the financial health of an organization. So I will go back to my Excel sheet so that we can see a few numerical examples. Such as here. So this is the ratio analysis, which we will see with some basic data. Obviously, real life data is much bigger.
It's not yet visible.
Sorry, it's not
Excel
yet
is
visible.
not visible.
Okay, okay, sir. Okay. One minute.
Yes.
Yeah.
Yes.
So, friends, we had some understanding of the financial statements. I know you all know that, but I just tried to put it in the perspective and went through that for a while. So, having seen the financial statements, while they give a lot of information, it's to determine the financial health of an organization. We compute the relationship of different items within the P&L account, or the balance sheet within the balance sheet, or items between the P&L and the balance sheet. So that's what we call ratio analysis or financial statement analysis. I think Mr. Kamath from Enam, that's what I understand. Earlier he was with Enam Financials. Am I right, Mr. Kamath? Yeah.
No, I was in marketing.
Oh, okay. That's fine, sir. So in any case, the financial analysts or the equity analysts are also very much interested in this ratio analysis. But of course, we as managers are also very interested because we want to know where is the organization headed. And let's see a bit of critical information that we get out of this analysis. So one, I said the GP ratio, which we already discussed briefly. So in the interest of time, I'm not going to that. But what we see is that whereas B Company Limited has improved its GP ratio from 35 to 42%, Company A has actually dropped its GP ratio from 35 to 29. A major part of this is because it has not been able to ensure the growth, which is 80% in the case of Company B. It's only 20% in the case of Company A. And let's also see if some part of it is because of the direct costs. And of course, at the next level, we looked at the operating ratio. A good gross profit ratio coupled with a good management of the indirect expenses led to a very healthy growth in the operating ratio here, 11 to 25%, whereas here it has dropped from 11 to 4%. Yes, I think I come to the question which Mr. Reddy has asked. Mr. Reddy, you were asking about EBITDA.
EBITDA, yeah.
Yes, so this is the number we have here. Earnings before interest, depreciation, tax, and amortization. What does this number signify? As I mentioned earlier, insofar as the gross profit ratio is concerned, is the efficiency of purchase and sale level of activity. As far as the operating ratio is concerned, it considers even the indirect costs. However, embedded in this operating ratio is depreciation. Number one, though in this example, interest is not included. We are interested in a different level of profit known as earnings before interest, depreciation, and tax. The reason being, depreciation is the outcome of the capital investment policy of an organization. Company X may go for Chinese machines and invest 1 crore, but company B may go for, let's say, European machines and invest 3 crores, right? Depending on the amount of investment we do in our assets, the depreciation, which is the annual charge for using the assets, or depletion in the value of the assets with passage of time, that's a depreciation. Whereas, depending on the original investment. So as in my example, in company X, the investment of 1 crore on machinery, but in company B, the investment of 3 crores. And assuming the annual depreciation is 10%, whereas in company B, the depreciation is 30 lakhs, in company A, it is only 10 lakhs. Am I right, Mr. Reddy?
Yeah.
So much so, we want to exclude this impact of management policy in terms of the investments in the capital assets. So we are removing depreciation, as the acronym goes, earnings before interest, depreciation, and tax. So I have explained the depreciation part of it. Let's look at the interest. I made a brief reference to this earlier. In company A, the owners are cash rich, and they decided, why should I pay interest to the bank? I'll put all my money in the company. So they don't have an interest cost at all. Whereas in another company, the owners are short of available cash, and therefore they go to a bank to borrow a loan. So what is the consequence? In one company, there is interest cost, but in another company, there's no interest cost. So what happens? Why the hell should it matter? It should matter because when we're looking at the efficiency of the business as such, the business model as such, how is it returning, how is it generating surpluses, interest and depreciation have become two items which tarnish the comparison. That is, if we look at profit after interest and after depreciation in this example, we are comparing apples with oranges. Do you all agree with me on this? If I look at profit instead of before interest and depreciation, at profit after interest and depreciation, I'm comparing two numbers of two companies which are not comparable.
You need to compare the same.
Exactly. So in one company, there is no borrowing. In that company, the owners are cash rich and they have put all their money in buying the best equipment from Europe, which has costed more. And therefore, the depletion in the, the depreciation, annual charge is more because the original investment is more. Whereas in another company, they had to borrow. They borrowed money for whatever reason and paid interest, which is a charge on the, which is a cost. And because they had no money, they went for Chinese machines, and which costed much less, so the depreciation charge is much less. So when we compare to these two businesses with the profit without adjusting for interest and depreciation, what we are doing is that we are saying that company A is fantastic, whereas company B is not. That is, we are comparing two numbers of two companies which are not necessarily apple to apple, but maybe an apple to orange. So this is a very important term which gets used in many financial conversations. In fact, analysts use this EBITDA very frequently, or even in business organizations, managers look at this number so as to exclude the impact of financing policy and the impact of investment policy. I hope it made sense, whatever I have explained.
Yes, sir. This how is this different from the gross profit? Is it different or is it the same?
Yeah, as you see here, this is gross profit, right? is 350 in this case, 750 in this case for the year 1920.
Yeah.
I'm just highlighting in green. Whereas, please see the numbers. I'm just looking at 1920, those green numbers.
Hmm.
Gross profit is 350, but EBITDA is 150. So they're different.
Okay.
And why are they different? They are different because at the computation of gross profit, we have just considered the sales, the purchase cost, and maybe the direct labor, direct expenses. But when I went into the EBITDA, I've also considered the other indirect expenses, including depreciation. At the operating profit level. And at the EBITDA, I have excluded the indirect expenses also. Am I right, Mr. Reddy? You agree with me? In fact, let me just show in the case of company A, what is that so-called indirect expenses. Indirect expenses 100, which is the difference. So that is the key point at the profitability ratios. Then of course we have just earning before tax, the tax, and finally the profit after tax. So what we see from this comparison of these two companies is that B is doing very well. It has got a healthier gross profit than company A, better operating profit, better EBITDA, and profit before tax. I'm showing it in terms of percentages and better profit. So where would we invest? Will we invest in company B or in company A? We will obviously invest in a company B, right?
B, yeah.
So this is the utility of this financial statement analysis or ratio analysis so far as profitability is concerned. Now we can extend it to the return on the investment. So one kind of investment is the total capital employed, whether it is a borrowed money or own money.
So I have one question before that. This net profit.
Yeah.
After taking off all the taxes and everything, depreciation, everything, that's the final net profit.
That is called the PAT, profit after tax.
Yeah. So that's net profit. That's what I just said.
Yeah. In fact, sometimes we look at net profit before tax. In this particular case, company B, it's 350 and after tax is 245 because the tax is 105.
Okay.
So we have here the investment ratios also. I'll go a little fast in the interest of time. We have, of course, one computation. When we say investment, what do we mean by investment? Is it just shareholders' money? Or money has no color, whether it is shareholders' money or lenders' money? Do we look at total money deployed in the business? So one measure we can have is capital employed, shareholders' money as well as debt. So we can look at profit before interest and tax and what is the return in percentage terms on the total capital employed, which is here. We can also have something like only the shareholders funds, which is here. Shareholders funds is 1,171. All these are taken from the balance sheet. And what is the return? The return is measured in profit before interest and tax when you talk of total capital employed. But when you talk of shareholders, what they have in hand is only after tax, right? That is a return on investment, which also reflects the profitable condition of the organization. And we have this profit after tax, what you have just mentioned. So we have, say, in the case of company B, 245 as the profit after tax. And let's say there are 1,000 shares. The return per share is 245 divided by 1,000, which is 0.245. In this case, it's a loss. It's a negative return. So per share, we're actually losing 0.05. That's called earning per share. There are a lot many measures like this which we can compute based on the investment. And I think we also looked at liquidity ratios. Liquidity reflects the financial health of the organization in the short term, within 1 year. So how comfortable are we to discharge our liabilities payable within 1 year, which is measured by the current ratio. I think this was mentioned by one of the participants. Current ratio, just let's look at company B for 1920. Its current assets are 1166. I have taken it from the balance sheet. I was mentioning we group the assets in the balance sheet. We group the liabilities in the balance sheet. This is the reason we group. These current assets, which can be realized within 1 year. Current liabilities, which have to be paid within 1 year. The ratio is 2.33. That is, current assets are 2.3 times of current liabilities. The norm is 2. And we can say this company is comfortable so far as the current ratio is concerned. So if I am to supply goods on credit to this company, I will look at the current ratio. Will this be able to pay my credit, which I am extending? I'm comfortable because it has current assets which are twice of current liabilities. On the other hand, here, it is only 1.5 times in company A. I'm a little uncomfortable. We can get even more conservative. We can exclude inventories and just take the cash related assets. We call it quick assets. That is cash, cash balances and marketable investments, excluding inventory. It is 700. Current liabilities are same, 500. It is only 1.4. As a norm, we are okay with 1 as a norm, but case to case it varies. So we are comfortable with the quick ratio also in the case of company B. The whole context of the liquidity ratio is the current liabilities which are payable within 1 year. We can extend it to just cash, so on and so forth. So I think there was a mention about efficiencies or turnover ratios. These are computed as times of investment in say receivables, which is debtors, and the sales. Debtors in number of days, I'll just explain that ratio. Inventory turnover, somebody mentioned fixed assets turnover, solvency ratios, will come to that. So one of the factors which influences the liquidity ratio is the efficiency with which we collect the debts. So in this particular case, we do it in number of days as an example, which is very important. What we do is, what are the debtors divided by the sale per day. In this case, it is 71 days is the money tied up in debtors. So my sales are 1800 divided by 365 gives me the days per day sale equivalent of 71 days when I divide it by my debtors, with my debtors. On the other hand, this company is inefficient. That's why its ratios are poor. It is locking up its money with debtors for 122 days. So this is one measure of your health of your organization. So similarly, all these turnover ratios. And of course, solvency ratios is the long-term financial health of the organization. Is the long-term financial health of the organization, which could be measured at the long-term debt divided by shareholders' funds, which is 1.02. Obviously, if there is more owners' money, the debtors are more comfortable. We can also look at not just long-term debt, but total debt with shareholders' money. Norm is again 1:1. This company is comfortable, and also this company. The problem for this company A is the short-term liquidity ratios. So, friends, I would like to quickly jump to the next part of the discussion because I think we are certainly running out of time. And I don't know whether we have the permission of Professor Mani to exceed the time limit a little bit. Professor Mani, or how about the participants? Are you okay if we exceed the time limit by maybe 15 minutes or so, 10 or 15 minutes?
Yes, sir.
Yeah, not an issue.
I'll be happy if everyone is agreeing to that. I know finance is quite a heavy subject, and being a very short session of 2 hours, I'm probably trying to cover a day's MDP into a 2 hours online session. And so much so that's good. But having said that, I hope you're all okay with if the session gets extended by, say, maybe 15 minutes to 6:15 or so. There are some exciting topics ahead. That's good. So let's go back to our presentation. I'll share the screen.
Okay.
Professor Mani, are you saying something?
No, I said it's okay. Go ahead.
Oh, thank you very much. Thank you very much, sir. And I'm sorry for taking a little extra time.
No, that I was there. Not to worry. Go ahead.
Okay. So friends, we have looked at the financial statements part of it and the ratio analysis. Another dimension which I wanted to touch upon was understanding cost. Understanding cost. You know, when we discuss about cost, probably we have one number in mind. But the fact is, when we look at it from the point of view of various financial concepts, costing concepts, or even, let's say, decisions, the term cost has many connotations. What we have discussed so far in the profit and loss account is an actual cost which is incurred by the organization, which is recorded post-incurrence, whether paid or not, and that's called a historical cost. It's called a historical cost. So Mr. Sanjeev Reddy asked me, what is the difference between gross profit and earnings before interest, depreciation, and tax? When we talk about the direct cost, we are probably getting closer to the concept of gross profit. But when we are talking about earnings before interest, depreciation, and tax, excluding interest and depreciation, we are also considering the indirect cost. What it tells us is that there are costs, some of which are called direct costs. There are costs which are called indirect costs. A direct cost is anything which can be attributed to a cost object. What is a cost object? A cost object is a process, a machine, a department, or any specific activity in the organization. In the case of probably Bombay Management Association, MDPs are a cost object, or within that, each MDP is a cost object. Maybe their conferences is another cost object. So direct cost, indirect cost. If you can attribute a cost directly to the cost object, we call it direct cost. So the maintenance cost of a machine, a particular machine, a spare I consume only for that machine, is a direct cost for that machine. And I'm computing the cost of running that machine. But if there are two varieties of costs, and there are certain lubricants which are used commonly for machine A as well as machine B, it is something which is common to two cost objects, object A, object B. That is machine A, machine B, and I have to distribute it on some proportion. And therefore, we call it an indirect cost so far as machine A and machine B are concerned. We have fixed costs. I'll come to fixed costs in a while. Variable costs that will change with the unit number of units produced. Marginal cost, the cost that you incur to produce one more unit. The difference being, of course, all marginal cost is variable, but marginal is with reference to one unit. Variable could be with reference to 100 units or 1,000 units or whatever. Standard cost, as we know, a marketing manager will not wait to know the cost before he reports to a customer. If you're looking for the accounts department, it will give you after 1 month. So in the meantime, we go by what are known as standard costs to help decision making. That's entirely tool, financial tool, which we apply. I mean, all organizations use all these tools. Incremental cost, something which is not just related to number of units, but say between 2 projects, 3 projects, or 4 projects. A project is not a unit, right? It cannot be quantified in that sense. Differential cost, opportunity cost. Opportunity cost is one which is really special because opportunity cost in the traditional sense is not a cost at all. It is an opportunity foregone. So if I'm putting in my business a lakh of rupees, on which I'm expecting a return of 8% or 10%, I could have as well put this money in a bank and earned a 6% interest. So in this case, the opportunity cost is 6%. Obviously, I will not put this money in the business unless I get that 6% at least. That's the opportunity cost. It's not an actual cost incurred, but it's an opportunity lost or foregone. So these are the variety of costs. I think this concept, cost drivers, is very important. Cost driver is a measure of resources that we consume. So let me give you a small context to cost drivers. Early in my career, when I was working in Bharat Heavy Electricals Limited, I was, of course, the finance guy. And I used to deal with a lot of commercial engineers. So Bharat Heavy Electricals Limited being a heavy engineering industry, we used to indent railway wagons to transport that heavy equipment. So this part of the responsibility of calling the wagons and dispatching was the responsibility of the commercial engineers. Sometimes the wagons used to come in and go out within the time allowed by the railways. The railways were allowing 2 days or 3 days or whatever, by which we should return the wagons or push out the wagons from our factory. Unfortunately, sometimes there was a delay in pushing out the wagons. It used to take 10 days, 15 days, 20 days or whatever. And as a result, the railways used to charge penalties on BHEL, which used to run into a few lakhs of rupees. I'm talking of the years 1984, 85, that's about 35 years ago. Yeah, I think it's 35, yes, 35 years ago. And as it happens in any organization, every cost has to be evaluated. And therefore, the commercial engineers used to put those proposals to the finance department, and that's me in this case. The notes used to come explaining that this is the damages we have to pay to railways. Please pay. So as part of my duty, I used to ask a few clarifications. And very unfortunately, my commercial engineers used to were quite irritated with those questions. And used to ask me, Murthy, why are you making such a big fuss on these penalties to the railways? Bharati Heavy Electricals is a government organization. Railways is a government organization. Both are the same person. Both are government of India. And you are making such a mess. And you accountants or experts in counting beans and wasting time. Very uncharitable comments.
I know, it's better to, yeah.
And what the commercial engineer was emphasizing is it is the same owner, it is transferring money from one pocket to another pocket.
Yeah, where the crowd is not.
So I had to explain to him that, look, my dear friend, you're just looking at the numbers, but not the resource behind those numbers. It is not 5 lakhs, but it is that wagons which are stuck in the factory for say 10 days. Yes, it is the same owner with 2 pockets, but the same owner is concerned for something else. That is, these wagons could have been used to transport food grains to various parts of the country instead of lying idle in our factory. These wagons could have been used to transport fertilizers to grow crops. These wagons could have been used to transport coal to the power generating stations. And if you just look at it in this perspective and try to understand why this cost is incurred, we'll come to the conclusion, probably it was for uncontrollable reasons, no blame. Maybe there were controllable reasons, will be better next time. So this is the kind of conversations I had, as I said, 35, 40 years back, and such conversations happen even today in many organizations. It's very unfortunate because people are just looking at the number and not the resource behind the number. That is what brings us to the concept of cost drivers. So if we want to manage costs, if we want to reduce costs, if we want to take the right decisions, we need to understand the concept of cost drivers. So cost drivers are the resources behind the numbers we see as a cost. So in fact, I would have loved to give many more examples, but due to paucity of time, I will just say that based on the simple principle of cost drivers, an entire sophisticated tool, which of course is by now 30 years old again, called activity-based costing. So you may like to read a little more about activity-based costing. It is entirely founded on this concept of cost drivers. So activity-based costing is a tool in use last 20, 30 years, which is different from the traditional tools of costing. And the use of activity-based costing has led to things like businesses realizing, businesses thought that product A is my good product, it's profitable, and product B is not. But when they applied the principles of these cost drivers and ABC costing, they realized, oh my God, product A is a loss-making product, whereas B is a profit. So this is, the importance of understanding cost drivers and applying the, which leads to, of course, tools like activity-based costing. I mean, there is an entire discipline known as strategic cost management, which is founded on this principle. So I think for our purpose, it's enough to say that we look at a cost not just in numbers, but also look at the resource behind it. So, of course, we have the what is known as economic value added. It's all related to the concepts of value. I'm quickly skipping this in the interest of time, but we have, but I certainly would like to touch upon value spiral because this is one mistake that most organizations do when they're faced with a financial crisis or a drop in profitability. So again, by way of an example, early in my career, again, some 30 years back, when a particular company which was earning super profits went into a loss zone, I'll be actually giving this example elsewhere also. When it went into a loss zone, what we wanted to come back to better profits or improve our profitability from losses. And what we did was to go for a cost reduction. And the entire cost reduction plan revolved around how to cut the stationary cost or how to cut the cost of telephones or, that kind of conversations, which I think I would say is very unfortunate because it has to, well, of course, we have to save printing costs, we have to save telephone costs, we certainly have to save all these costs. I'm not belittling the importance of any cost, but having said it, engaging in this type of conversations only means two things. One, we are not going to turn profitable. And number two, we are going to lose sight of the more critical and strategic factors which drive the profitability. So it gives a false sense of complacency that we are taking action. So that is exactly what happens when we are trapped in what I call a value spiral. So typically, I have seen this happening even in organizations just a few years ago, when the profits are under pressure, we cut down, for example, on the human resource development cost, say the training cost, or we cut upon the investment in technology. So these are all panic reactions, which actually mean that our ability to create value is getting reduced. All this we do ostensibly to improve profits, but actually it's a vicious cycle in which it further reduces the value creation. and penultimately we get into deeper and deeper into losses. I think there are a few HR professionals here, including Professor Mani, and I hope they agree that at a strategic level, we should not cut down on certain costs, profits or no profits. And that's what is called value spiral. And again, these are all concepts which you can also find in the internet, and you can get a deeper understanding. So finance is also, as I mentioned, in the myths part of it, it's not just about gathering data. It's also about assisting decisions. So let me go to these few decision-making concepts, which is again in my Excel sheet. And therefore I have to go back to that sheet. I'll stop sharing this. These concepts I will explain through the Excel sheets. Okay. Are you able to see the Excel sheet, please?
Okay.
Yes, sir. So the break-even analysis is all about finding what is known as the break-even point. So the break-even point is that point or that quantum of sales at which the organization incurs neither a profit nor a loss. It's neutral. So elsewhere we have discussed costs are variable or fixed. Variable costs are those which change with the quantum of activity, and of course remain constant for every unit, extra unit produced. Fixed costs are constant. Whether you produce or not, you will incur those fixed costs. So the whole break-even point or break-even analysis is based on these two simple maxims. One is costs are either variable or fixed, number one. Number two, costs contribution is sales minus variable cost. Please interrupt me if anywhere I'm getting complex or too fast. So here is a case of A company and B company, our two favorite companies, where they have a production capacity of 150 and 150 units. Small numbers for demonstration purpose. They are currently producing 100 units and 100 units. What it means is that they are not utilizing their assets completely, their plant fully. It is a 66% utilization, 100 of 150. Now, this 100 units, both are selling 100 units each. Company A is selling for 1200 rupees or 1200 thousands or whatever, and company B is 1800. So obviously the sale value is 1800 and here it is 1200. So since the total value is 1200 and the number of units are 100, sale price per unit is 12. And here 1800 divided by 100, it is 18. Right? That is the sale price per unit. What is contribution? Contribution is sale price minus variable cost. So let's look at the variable cost. Hypothetical example. Let's say it's 1000 rupees in the case of company A and 1200 rupees in the case of company B. That is the cost of raw material, the cost of direct labor. So the variable cost per unit is 10 rupees and the variable cost per unit is 12 rupees in the case of B. Okay, B sells more, but it has a higher variable cost for whatever reasons. Maybe it uses costlier raw material, which is higher priced. So suffice it to say that sale price is 12 and 18, variable cost is 10 and 12, and contribution per unit is 2 and 6. That is 18 minus 12 is 6, 12 minus 10 is 2, contribution per unit. And let's assume that both have a similar amount of fixed costs. That is the cost of managing their accounts department, the cost of rent, office rent, and all other overheads that any business has to incur, which has got nothing to do with the number of units of sale. Whereas variable cost will vary with the number of units of sale. Fixed costs are constant, 250 and 250. So now we are interested to know what is the break-even point. The break-even point is fixed cost divided by contribution per unit. As I said, at the level of contribution, we already covered the variable cost. What we need to cover is only the fixed cost to achieve the no profit, no loss zone. I hope everybody is in sync with what I'm talking. The break-in point is 250 divided by contribution per unit, 2 rupees, which is 125. In the case of company B, it is 42 rupees because the contribution per unit is 12 rupees, 6 rupees divided by, 250 divided by 6 per unit is 42 units. What this really tells is that company B is excellently placed, even if it can just sell. What is its production capacity? We saw it is 150. What is its break-even point? 42. That means even if it can achieve a production of 33%, it will be in a no profit, no loss zone, or at least better than a loss zone. Whereas company B has to achieve a production of 125 units out of 150 units because of its cost structure, the variable cost structure, or rather the contribution. And obviously, it is short of 25 units here from the break-even point because it is selling only 100 units. It is foregoing a contribution of 2 per unit on 25 units, which is 50 rupees. Am I clear so far? I hope it's clear. The critical data points in contribution break-even analysis is sale price per unit, variable cost per unit, contribution per unit, fixed costs, and of course the break-even point. Company B is better placed, and that's why it's earning profits. It is selling over and above break-even point, which is no loss, no profit, 58 units more, and earns 6 rupees every unit after covering variable cost of 12. And therefore 58 into 12 is what it earns. Now let me ask a few questions. Are we clear on this, please? Because the few questions I have here are related to understanding this. Sale price per unit, variable cost per unit, contribution per unit, break-even point, of course the quantum of fixed costs are the critical variable points. Now both companies have a problem. The problem is they have a spare capacity of 50 units because they're actually selling 100 units, but their capacity is 150. Every company would like to use its capacity to the fullest. So these companies have received an export order at the rate of 10 rupees per unit for 50 units. My question is, should company A and company B accept this order? Company A, company B. I just put that data for you. Yeah, you can tell me. This is, they have received an additional order of 50 units. Both of them are very happy. We got 2 orders, 50 units, 50 units. We will increase our production to our fullest 100% utilization, but they are getting a price of only 10 rupees. Should they accept it? Should company A accept it? Should company B accept it? That's the question. This is the base data.
No, I don't.
Hello.
So B can accept it.
Okay. You said B can accept it, so I'll put a
Yes.
green for B. You said A cannot accept it by inference.
No, A can, yeah, A can't accept it.
Okay. So why should B accept it?
So because they'll break even on the 42nd machine, right? So the excess machines will be pure profit for them.
I'm sorry. I think the reference was to the units of the product,
Per unit
not to
is
the number
12
of
Per
rupees.
unit.
Per unit is 12 rupees, I think, variable cost for them. So if they are selling at 10 rupees, then they are maybe selling at loss.
Absolutely, sir. It is a loss if B takes this order. 50, they are spending 12 rupees variable cost. Fixed costs are new there, whether they take this order or not.
Okay.
And they're only getting 10 rupees. Actually, they're going to increase their losses. Let's take another example. Let's say this export customer says, okay, I'll pay you 12 rupees per unit. In this case, should A or B accept it? The variable cost here is 10 rupees and 12 rupees here.
Yes, both can take, but B will make more profit.
You said both can take, both are green, but B will earn more profit. Is it that?
Yeah.
Let's quickly see. This is A and this is B. So A has accepted this order at 12 rupees, right? Rather the order for 50 units at 12 rupees. And sorry, which gives it a contribution of, I think it's 2 rupees, right? The contribution is 2 rupees that they get. Export order at 12 per unit. Their contribution is 2 rupees. They're getting that 50 units extra and they're making 100 rupees A, which will offset their loss of 50 and put them into the green zone. So that's absolutely right. Company A can take it. Now let's look at company B. Company B's variable cost is 12 rupees. 12 rupees. And it's going to get 12 rupees from the export customer. It's going to get 12 rupees from the export customer. So what does it earn? The differential contribution is nothing for it. It spends 12 rupees, it gets 12 rupees. It doesn't make a difference for B at all. So B also will not accept that order. Am I right? Is it clear?
Break even. Yeah, not much, but break even is at 42 units. So
Yeah, the question here is, they have get an order for 50 units at 12 rupees. When they produce those 50 units, they will produce it at a cost of
12 into.
yeah, that variable cost is 12 rupees per unit. And what they realize is also 12 rupees per unit. So the contribution is 0.
Contribution per unit is 6 rupees, so they should take it.
It is 6 in this case where the price is 18.
18. Okay.
But here the price is becoming 12, sir.
10, 12. Okay.
Variable cost is 12.
Okay.
So it's 0. So it doesn't
Yeah.
make sense for them.
Right.
Well, obviously, if the price is 16 rupees, it's good for both of them. So I will not get into the calculations, but you will agree with me that by the same principles which were discussed, at 16 rupees, it's worthwhile for both of them to take this order.
Yes.
Right? So I'll quickly go into what is known as leverages. A leverage is like in the is a term which refers to multiplying effect, multiplier effect. As in engineering, leverage in the case of finance also, we leverage on the fixed costs. So fixed costs can be of 2 categories, which could be operating fixed costs and financial fixed costs. Right? So here is the sale price, sale value, variable cost, contribution. We have just discussed all this. And when we talk about the fixed cost to arrive at profit, it is 80 rupees. 60 rupees is operating fixed cost like rent, accounts department, salaries, etc. And 20 rupees is the interest cost. Net profit is 20 rupees. So the operating leverage is defined as contribution by PBIT. Here is the contribution. Here is the PBIT. Contribution by PBIT, 100 by 40 is 2.5. 100 contribution divided by 40 is 2.5. The formula is not what is important, but I just demonstrate what a powerful tool it is. Or you can look at financial leverage, which is defined as PBIT, which is PBIT. We discuss PBIT and all when we discuss the financial statements. And interest is 20. 40 by 20 is 2. This is times 2.5 times 2 times. Now, I said leverage is all about the multiplier effect of this fixed costs. So look at the operating leverage in this particular case. The sales are down by 10%, from 200 to 180. Okay. And therefore, the profit is down from 20 to 10. Our operating leverage in this particular case is 2.5 times, which we computed here, into the sales drop of 10% is 25%. So the simple point is, if sales come down by 10%, your profit before interest tax will come down by 25%. Similarly, if the sales increase by 10%, the PBIT will increase by 25%. That we can see here. 30 becomes 40 becomes 50, that's 25%. 40 drops to 30, which is 25%. We have the financial leverage, which is 2 times, which is defined as basically the PBIT by PBT. So when we compute it, the financial leverage impacts the profit before tax by 50%. We can prove this arithmetically, but in the interest of time, I will leave it at that. But the important point that I'm trying to communicate is that this particular financial tool of leverages helps us to study how risky is our cost model in the organization. So we all know these are pandemic times, Corona times, and many organizations which have built fixed costs in terms of rent, office space, etc. today are suffering because the sales have dramatically come down. And it's all a waste of money. So of course, Corona is something which cannot be anticipated. But in the regular course of business, we can clearly see that fixed costs are a burden. Of course, they help us to magnify profits, but they can also result in equally pulling us down the hill at double the speed. So that's what comes out of financial leverage. And of course, the combined leverage is the product of these two. And what we'll do is we'll just go back to the presentation and we'll quickly conclude in the next 10 minutes. So we have seen the leverages. Let's go to the, we have seen the break even, we've seen the leverages, and these are all the leverages which I explained through that numerical example. This is investment decisions. Whenever we take a decision, again, there are a lot of financial tools and concepts which go to help us in taking the right investment decisions. What are the criteria on which we decide whether to invest or not in a project or in an equipment? It is a function of the risk, it is a function of the returns we expect from that product, and it's a function of the cost of capital. These are the 3 factors. We have, of course, the payback method, the net present value, the internal rate of return. The difference being that these two consider the time value of money. 100 rupees today is more valuable than 100 rupees after 1 year. That's what we call the time value of money. So in the interest of time, I'm not going into these details, but I'll give you an example of how the concept of leverages and these investment decisions can even kill a company. So let me narrate an example of, again, an organization that I worked for several years ago. And this was about a company which was earning a whole lot of profits, huge profits, because we were in a very monopolistic market. And something like what we used to sell at 12,000, we have increased, jacked up the prices within 1 or 2 years to 23,000 or 22,000. So that's the kind of prosperity that we enjoyed. But we had a limiting factor, which was we were power intensive industry. And in the particular state in which we were, there were power cuts. And therefore, despite such a profitable market, we could not produce 100%. And we have to shut the plant in the summertime. So the management felt that let's take a decision to invest in a power plant. I'm giving some hypothetical numbers. We were to invest 50 crores in the power plant. Projections were made and we invested the money. So few mistakes happened. Mistake number one. We financed the entire investment, the bulk of it, 45 crores, by way of loans, which in those days used to attract interest rates of 16%. IDBI and other financial institutions used to charge 16% interest rate. So we just saw the leverages. So we built a huge financial leverage to our disadvantage in this case. It could be to our advantage also sometimes, but to our disadvantage in this case. And invested 45 out of 50 crores through loans in the power plant. Number two mistake. There were certain assumptions. I said, when we talk of an investment, we talk of the risk, of the returns, and the cost of capital. There were certain projections made of what we learned from that investment of 50 crores. And the projections were entirely, I would say, in retrospect, over-optimistic. So the assumption was that we'll continue to sell the product at, as I mentioned, the new rates of 20,000 and 22,000, one of the products. And we're going to produce the balance 50%, which we could not produce because we didn't have power. Now that there's a power plant, we'll produce the balance 50%. Wrong assumption number two. Wrong assumption number three, the market demand will continue to be to meet what we produce, I mean the 50% additional capacity. So, friends, what I'm trying to drive it here is that this company, which I cannot name, has unfortunately witnessed a downturn after this power plant was commissioned. Number one, there was a competition building up around, which was not seen, which was underestimated because it were all small fellows who were coming in. They thought we are big, nothing can happen to us. But all these small fellows put together were big enough to offer material at much lower prices in the market, and the sale prices tumbled back to the earlier prices of 12,000 or 14,000. Whereas we thought we'll sell at 20,000, we are now selling at 14,000. You can see the impact on the profits and the cash flows. We have seen various cash ratios and the profit ratios, the impact. Number two, because of this downturn and the lower profitability and the lower cash flows, we have ended up with a situation in which we were making huge losses. Our liquidity ratios went haywire. We had no money to pay the suppliers. We had no money to pay salaries. Very tough days. And on top of it, we had this fixed loan commitment, interest commitment on those loans which we borrowed at 16%. So we have two lessons from this. One is, look out for what is your financial leverage. Look out for what is your operating leverage, because the power plant was also a fixed cost. We recruited engineers, we recruited operators. We had depreciation. we had the maintenance which we had to do, whether we operate it or not. So very soon, within 1 year, a situation came, our production has come down by more than 50% down, and the power plant has to be shut down because we just could not run it. Our cash flows were affected. I was the finance manager at that time, and all this happened not because of me, but in spite of me. In any case, I was on a much lower first line management line or middle level at that time to influence any decision. So, I mean, what I'm only trying to say is that this is what has happened. And as I said, I can't name the company, unfortunately. It's a wonderful company. It is a very charitable company. All good. Only thing bad is this investment has been a disaster. And I can tell you, without naming the company, that even today, it has not fully recovered. And I'm talking of 25 or 30 years. It has not recovered in such a long period. All because of this one misstep. And of course, there are several other factors. So that's where this sensitivity analysis comes. So, and all these tools, of course, have to be applied with the requisite care and caution. So friends, I don't think we'll be able to really get into this budgets and other topics which I wanted to discuss. I will just leave it at the point, since most of us interact with budgets, I will leave it at the point that budgets are a product of strategic plans. Budgets are not an operational activity. We need to understand where is the organization headed and tie down our budgets to the strategic plans. And of course, the individual goals are related to budgets, which lead to our growth and the performance related pay, so on and so forth. I would leave these slides for some other opportunity. And I'll be happy to take some questions if Professor Mani permits for a few minutes before we wind up. And my apologies if I had to rush through towards the end. And we probably have been trying, I rather have been trying to chew more than what I can digest in a short time of 2 hours. That's a learning. Thank you very much.
Thank you so much. I think that was rather exhaustive, and I hope you're not exhausted.
Not exactly. I only hope the participants are not exhausted. There was a lot of monologue in this session.
I understand, but I guess one of the main takeaways, as I understand, is finance and accounts are more than often being seen as compliance-related areas and regulatory areas. But I think the entire perspective which you presented so clearly positioned finance as an area which could be really strategic, which could be an enabler to organization success or to productivity more than anything else. I think it was that dimension which was a big takeaway as far as I was concerned. I'm very happy to have some participation, and what I'll request you, Murthy, is if you can just switch off your presentation. We'll get everybody on the screen.
Sure,
And,
Can I just see the slide 17, please? Leverage the slide.
You want to go back to slide 17?
Yeah, 17. Leverage, the one which is on leverage.
Sure.
I think one before this. Yeah.
This one, yes.
Yeah. Okay, you have already covered that in that Excel.
Great.
Thank you.
So you can just put this on.
I'll just stop the screen share. Just give me a second.
No problem. That's it. So everybody can actually, you can unmute yourself and speak. Anybody who is interested, you are allowed to unmute yourself. You can put on your videos also so that we can get to see each other. Yes, please. The floor is open for discussions. Feel free if you have anything to discuss. Yeah, you can just unmute. That's it. You've been given unmute permission. That's right. Except that if you're not speaking, mute again. Otherwise, we hear all kinds of noise in the background.
I just want to say that given the time limit, I think Professor Murthy has covered the overall in a nice way. Thank you for that.
I didn't see.
Thank you,
I
Mr.
realized Kamath was speaking. Okay.
Yeah,
right.
yeah. Kamath was speaking. Sorry, my camera is blocked
No, no,
by
no
the
harm, no harm.
antivirus, and so
Thank you, Mr. Kamath.
yeah.
Not to worry. Any other point anybody would like to make? Any questions?
Yeah, I think thank you, Mr. Murthy, for this program. It's a very vast subject, but definitely you tried your best to, I think, cover most of the good, very good, wonderful concepts. And I request a BMA can have a full day session like this or some MDB program on this with much details we can discuss. Yeah.
Surely. I
Thank you,
appreciate
Mr.
the
Reddy.
feedback. You know, as all of us know, even we are going through a transition of learning from physical to digital. And sometimes we are all worried what is the level of digital patience people have. Notwithstanding the quality of faculty and the desire to learn, sometimes sitting in front of a computer for many hours could be backbreaking, as they say. But having said that, I will take this feedback in a positive spirit and see how we can have more longer duration programs as we proceed. Anybody? Mr. Bosle, Mr. Tyagaraja, Ishan?
Yes, Tyagaraja here.
Please go ahead.
Hello. The session was excellent. It has given a bird's eye view of the activity of finance. As you have mentioned a minute back, this is not simply accounting. The finance activity is largely management activity. It looks and the importance of finance in managing the firm to bring it to a success that has been excellently presented by Shri RSR Murthy. Thank you.
Thank you, Mr. Tyagaraja. Professor Mani, I mean, after we conclude this question answers, I just would like to go back to one last slide, which I think will sum up the entire session. It may just need about 3 or 4 minutes.
No worry at all. So, all right. I'd like to request our Indrapal Singh ji, always a very, very respected person in industry, a doyen in the field of management, and who's been a past president, and Murthy, you also know him. I'd like Indrapal ji to say a few words and capture some of the thoughts of this program. Indrapal ji?
Yeah, thank you, Professor Mani. I have unmuted myself. Can you hear me?
Perfect. Yes, we are able to hear.
I think, Mr. Murthy, you conducted with great clarity and sharpness. All the concepts that you explained, I think, became very clear to even a person like me who has been not in touch with finance for many, many years. So I think this you are a wonderful teacher. So that's the point number one. The second thing is that it should be made compulsory, I suppose, in the organizations for anyone who has a title manager or assistant manager or something like that to understand the basics of finance. You know, for the first part, I mean, before the cost drivers, what you did and the financial analysis, that should be made compulsory. Regardless whether the persons are MBAs or not, I think in the practical situation to understand, given the company's financials themselves, if people can learn to carry out and understand the implications of good financial management, I think that will prevent many, many pains later on. So that would be the point number two. And I believe a break-even point is so fundamental that it has probably gone out of fashion these days. I remember when Toyota Motor Company made the global loss for the first time way back in 2011 and 12, and the chairman then, Fuji Cho, was sacked or promoted to vice chairman of the company. And the founder, Akaido Toyoda, the son of the founder, took over. He apologized to the shareholder that Toyota in his whatever 60, 70 years of history for the first time made a loss and said, I have told my operating plants to lower their break-even point to 55% from 65% existing so that we never run into this situation. Now you can imagine the power of companies operating at 55% break-even point in today's pandemic time where the sales are dropping like no one's business. How much resilience and the robustness could be there in the organization. And this is coming from one of the most efficient manufacturing company in the world, saying that we want to drop our break-even point to 55%. So I think that sort of a perspective, if we can bring among our operating managers, then finance can become a true partner of the business. The fourth stage in the first slide that Mr. Murthy showed. So these are the few things I want to share here.
Thank you, Indrapalji. I think that was a very good summary of some of the key points. Before I go back to Professor Murthy, and I think I was right in calling him Professor Murthy for the wonderful, comprehensive, full of clarity presentation that he shared with us. We have this nice little ritual that we follow every Wednesday and every Friday, is to take a group photograph, though virtually, of everybody who's present here. So can I request you to put on your screens while our digital experts from the Secretariat of BMA will quickly take up a moment to have a photograph which we can cherish as a memory of your participation in this program today. So can I request Uday, Ishan, Nitin, and my colleagues Hoimi, Supriya, Lakshmi, let's have your cameras on. You can take a minute to get ready if you wish. That's all that's allowed in the digital space. Right, so we're almost getting ready. Indrapalji, your camera is on?
Yes, yes.
Yeah, I know we are not seeing you. That's why I asked you that question.
Oh, now? No,
yes, now, but you got to just focus it on yourself. We are seeing some furniture.
How do I do that? Yeah.
We are seeing some furniture.
How do I do that?
You should call your grandchildren. They are the experts.
I know. Lovely.
They are the experts.
I'm foxed. Oh my God. I think I turned the camera upside down.
Yes, we see you now.
Yes,
Yeah.
absolutely.
Normally they are around this.
Yeah, Uday had some problem with this camera. So let's say, get ready for this group photograph of today. So thank you, everybody. Just want to make this announcement as we sign off. Next Wednesday, we have a very interesting webinar on the future of drones. You will, of course, get the intimation, so please join us, as many of you always do. And next Friday is a very unusual session, very interesting one. This is leadership lessons from Chanakya. I repeat, leadership lessons from Chanakya. Those of us who are on our databases will keep getting all the mailers. In case you're not a member of BMA, we'd be happy to welcome you to our family. In case you want more information, please reach across to Hoimi, who would have sent you all the details of today's programs, and be in touch with us in BMA. Have a lovely weekend and stay safe and stay blessed is all that we would like to say on behalf of BMA. To wrap up, over to Murthy, sir.
Yeah, I will just take another 2 minutes. I thought I could sum up. Yes, sir. Since we could cover some of the topics, I thought this summary slide will be a good conclusion to what I wanted to say. To sum up the whole session, I think what we could remember as a takeaway is finance is an all-permeating function. So it is everybody's job to understand a bit about finance, as very well said by Mr. Indrapal Singh also. And the other is, of course, financial data numbers are very interesting. They're very exciting. And the third is only, of course, you look for that. What balance sheet reveals is interesting, but what it hides is exciting. There's a lot to know from the balance sheet. In fact, I have a few anecdotes which I don't want to say here because there are honorable ladies in this grouping, and I will be viewed as a what I would say anti-feminist or something like that. So balance sheet is very interesting, but what it hides is exciting. Cash is king, cash is real, profits are a mirage. So we need to be extremely conscious of the cash flow statements and where cash is coming in from and where it is going. And one more mantra, which I could not spend much time upon, is borrow long, invest short. So very often what happens is that we invest long, but borrow short. And when we want to repay, we don't have the returns from that investment. So that's a dangerous situation. Borrow long, invest short. Understand how value is created and the appropriation happens. So this is how we can actually build the financial health of an organization. We have spent a lot of time on this in the early part of this session. Keep a watch on the score. Look at financial statements and reports with a keen eye. They are not something which you should keep away from, because they have a lot of information which will help you in your job, which will help you in, of course, the financial prosperity of your organization. And finally, keep a watch on the big picture, the strategic dimensions, like as it happened in that investment example that I gave. The problem there was that their management was so inward looking that it has ignored what is happening around, the competition, the trends in the sales, the potential drop in the sales, etc. So I think these are some of the few takeaways which I would sum up, and I would like to thank all the participants very much, and of course Bombay Management Association and Professor Mani. And I only wish that I should have told Professor Mani that this is a 4-hour session, whereas I tried to fit into 2 hours. That's quite a bit of a compromise both for me and certainly for the participants. Thank you very much once again, and look forward to seeing all of you sometime. Thank you.
Thank you so much. Thank you.
Thank you.
Thank you. Thank you very much, everybody. Thank you,
Thank
Mr.
you.
Murthy and thank you, Professor Mani. Thank you.
Welcome. Thank you.
Thank you.